All right. Well, I think we have a quorum. So I want to thank everybody for joining us today. If we haven't met before, my name is Kara Murphy. I am the Chief Investment Officer here at Kestra Investment Management. I oversee a team of 14, as I often say, investment geeks. We like to wake up every morning and think about markets and portfolios, and the markets over the last few weeks have given us a lot more to chew on than we often see. But we think a lot about these things, and we know that there's a lot of anxiety out there. So we wanted to be able to give some insight into what we think in terms of tariffs, how we think it impacts the market and the economy, and how we should think about how to position portfolios going forward. So before we dig in, thank you to everyone who answered our poll question. It's always very helpful for me to understand, what's top of mind for folks. And I'm going to go ahead and end the poll. And let me share the results so everyone looking in can hear. So certainly top of the list here is that people are worried about possibility of a recession or generally economic downturn. And then it looks like impact of tariffs causing higher prices and being able to retire when and how I want is about even. So very interesting. So we're definitely going to talk about sort of the impact on tariffs on the overall economy and what the market is currently anticipating, because ultimately that's what really matters. So with that, let me pull the poll down, and then we'll bring you to, well, after we see the very important disclosures. My Chief Compliance Officer will be happy with me for sharing that with everyone. But I want to just share kind of the different topics that we're going to cover. Now, I may not be covering everything that you're interested in. So if you'll notice, there's a button down at the bottom of your screen. It says Q&A. If you click on that, you will be able to type in a question. You can do that at any time during the presentation, and then we'll leave hopefully 15 minutes towards the end to be able to answer any questions that you might have. But first, I want to talk about kind of what we were looking at coming into 2025. Then look at, John, if you don't mind going back for just one moment, then talk about what's happened in the markets. A tremendous amount has moved in the markets in a very short period of time. So I wanted to sort of illuminate a little bit the different areas of the market that have been moving and why. Then talk about where the economy was positioned before this, because it's very important to understand how well an economy is set up to handle a shock like what we've seen with tariffs. Then we'll dig into some of the specifics of tariffs, sort of giving you some insight into how we're thinking about it and what we think the sort of pull through will be for both American consumers and businesses. Then we'll talk a little bit about how we're addressing this in portfolios and then some of what you can expect next. So if you don't mind, thank you to John, who's been very helpful in putting a lot of this research and charts and whatnot together. And he's also driving for me today as well. So as we entered 2025, I know it's probably very easy to forget already, but 2023 and 2024 were extraordinarily good years for the market. We had S&P 500 rising over 20% in those 2 years, some very, very strong relative to historical levels. But what that meant was that created some risks that were inherent to the market at the beginning of 2025. A lot of those risks were concentrated in what came to be known as the Magnificent Seven. So you've probably heard this term before. It's think like Amazon, Apple, Tesla, Google, all those big names that happen to be both among the largest stocks in the country and the best performers over the last 2 years. So that's great. They had wonderful earnings. They had, new technologies, but as they became bigger, they became a larger and larger proportion of the overall S&P 500, and they became quite expensive. So you'll see on that lower left there, we look at one measure of how expensive a stock is, and that is the stock price compared to how much it's expected to earn. What you see there we take the largest 10 names in the S&P 500, so think Magnificent Seven plus a couple of others. That price to forward earnings was almost 30 times. And that compares with the rest of the S&P 500 at just 18 times. So you had this really wide differential between how much the market was willing to pay for these handful of names versus everybody else. And those handful of names were very, very large. That represents a risk for us. The other main risk that we were focused on, we put under a bucket generally of policy uncertainty. So you had an administration who was elected on the idea of introducing a lot of change. And you know, whether you agree with that agenda or not, it was meant to introduce this significant change. And so this index on the lower right, this is global policy uncertainty. So this is not just the US, this is looking at around the world. And I think that last data point is actually from January. So before these tariff announcements started to come out. So I would expect that to be even higher today. But what this tells us is that around the world, there was a lot of question about what policies would be going forward. Again, that introduces risk. So we have high valuations, or markets are sort of priced for really good stories, and then a high level of uncertainty. And it's those two things together that have created the volatility that we've seen today. And then so let's talk about tariffs for just a moment. And if we look at the tariff rate going back over 100 years, we're able to calculate the amount that the US government has collected relative to the total level of imports. So John, if you don't mind going to the next slide, we can see here going back over 100 years, it has been going down pretty consistently for most of that time. So you see the Smoot-Hawley Tariff Act, those were tariffs that were introduced during the Great Depression, and were largely, the consensus after the end of the Depression was that those tariffs actually worsened or deepened the economic downturn that we experienced during the Depression. With that, policymakers focused very squarely on lowering barriers to trade, lowering tariffs, encouraging global trade. And with that, tariffs not only came down, so that's what this is measuring, but trade went up. It makes sense, right? If it's cheaper to buy something from another country, you're going to do more of it. And so with that, our supply chain became much, much more complex, much more globalized. And then with the tariff Trumps that came in his first administration, that was one of the first times that we've started to see tariffs increase, even modestly. Now, I will note that the Biden administration kept those tariffs in place. And then, of course, the newest level that we have, you can see here where that's taking us back over 100 years in terms of what that tariff rate is. So we'll dig into this some more. But I wanted to put in perspective, like, why this is so important. This is a really big change from a very long period of policy that was focused in the other direction. All right, so let's first talk about what's happened in the market. When we look at the different asset classes, you'll see very varied reactions to what has happened. And we talked earlier about one of the risks we were very focused on was the high valuations and large concentration in the Magnificent Seven. You'll see there year to date, so this is looking at the first of the year to yesterday's close, the Magnificent Seven were down 18%. So that's a fairly large drop. That compares with only 7% with the S&P 500. Interestingly, when you then go over to developed ex-US, so this is largely Europe and Japan, those markets are down only 3%. As of a couple of weeks ago, they were actually up significantly for the year. So the first time in quite some time, what you're starting to see is non-US markets outperforming US markets, and then broad US markets outperforming those big Mag 7. If you look at those blue bars, those are bonds. High yield tend to be higher risk bonds. These are companies that are levered more, probably younger, more concentrated, rely more on borrowing. You'll see that those are negative for the year. But if you look over towards the right at the US bond aggregate, this is a measure, very wide measure of a lot of different types of bonds. This is pretty reflective of what most investors have in the bond portion of their portfolios. That's actually up so far this year. And this is an important distinction to the downturn that we had in 2022 when you had stocks declining and you had bonds declining. Here, bonds are doing what we count on them to often, which is that they rise in times of turbulence when stocks are falling. All right, with that, let's take a look at sectors, because this is another area, even once you dig into large cap US stocks, there's a lot of differentiation in how the market is treating these stocks. All the way over on the right, you'll see information technology and consumer discretionary. That is where the Mag 7 lives. There are a lot of other companies in those as well. Those are the two sectors that have done the best over the last 2 years. So they did great the last 2 years, not so great so far this year. On the left, you'll see those bars that are in the positive territory: consumer staples, healthcare, utilities. These are often sectors that are seen as quite defensive. So think consumer staples, that's razors and shampoo and toilet paper, all those things that you have to buy on a regular basis. And that when times get tough, you're probably going to still buy, right? You might trade down from a premium brand to a discount brand, but you're still going to buy that shampoo. And hence, those names tend to hold up better in times of stress. And so that's exactly what we're seeing here. One other interesting distinction in the market is this difference between growth and value. So growth companies tend to be faster growing, maybe a little bit younger. We tend to pay more. We're willing to pay more for those names because we expect earnings to be a lot higher in the future. You'll see full year 2024, those names did really, really well. The gold bar is value names. Those tend to be more mature companies, slower growing, but cheaper. Those names really lagged last year. This year so far, they're doing quite well. So what that tells me is that this is not a wholesale, investors are just selling everything. Investors are being discerning about what areas of the market they want to be exposed to given the new economic environment. And investors are choosing to move away from some of the recent winners into some areas of the market that have been more overlooked in the recent past. And let's talk about the bond market for a moment, because there's been a lot of discussion here. And we've seen a fair amount of volatility just over the last couple of days. So on the left, what we're looking at is the yield on the 10-year US Treasury. So when the US issues a bond for 10 years, this is what that trades at. And what you saw is that in the latter part of 2024, that yield went up significantly. And mind you, this happened even as the Fed was cutting short rates. And then you'll see as Trump took office, it's been much more up and down. Now, I created, you can see a minute by minute chart on the right. It's a little hard to read, but I wanted to be able to show this because there's been a lot of talk about the bond market sort of being the stress indicator, and what convinced the administration to then have a pause on tariffs. So what you see on the right is the par value. So how much is that bond worth? As yields go up, bond value goes down. So what you see is over the last couple of years over those last couple of days, you see a huge drop in the par value of that bond. And remind you, this is huge for the treasury market, right? So the treasury market is very large, most liquid market in the world. So when you have swings like this, you feel them a lot more. But when you see that really big drop in the value of the bond, I marked there where the tariff pause was announced. And you can see the par value of the bond stabilize during that time. So the fixed income market has also been trying to digest this news, and it's been very much kind of risk on, risk off, depending on which way tariffs were going. So they're an important part of this whole story and trying to understand sort of the way forward. I want to mention just a couple of other asset classes that have been impacted by this. One is oil, which has been very interesting to watch. So we have a couple year period here that we're showing. That dark line is Brent crude oil. So it's a typical measure of how much we're paying for oil. And you see that really high level in 2022. That's when inflation was very high, a lot of concern about prices getting out of control. This really hurt consumers' pocketbooks. But then pretty much over the next 3 years, oil has just been coming down. Then over the last couple of weeks, it's a little hard to see in this chart, but you see this big drawdown in oil. Why is that happening? As tariffs have been instituted, there's concern about slower economic growth. And with slower economic growth, there's often less demand for oil, so oil prices have dropped. Now, there might also be some political brinksmanship as well, because OPEC has been making statements about increasing production, which would further lower oil prices. So there's a lot going on in those markets as well. But let it be known that this is another piece to the puzzle. Lower oil prices are usually good for the consumer. So as we think about potential higher prices with tariffs, this is one other potential lever to kind of lessen the blow a little bit. One other asset class that's been getting a lot of focus is gold. So that's the gold line. And you will see that over the last couple of years, that has been rising significantly. So there's been growing investor interest in gold. But when we've looked at this in the past, we think a lot of this is being driven by central banks around the world buying additional gold. Interestingly, and again, it's a little hard to see in this chart here, but over the last couple of weeks, gold has actually turned down. Now, what's driving this is a harder question, but just keep in mind, we're having that the point of showing this is that we're having a number of asset classes that are reacting in different ways depending on what the sort of longer term impacts are of tariffs and some of these other policies. One other thing I'll note about the market before we move on to the economy is price to forward earnings. I mentioned that this is one way that we determine whether the market is expensive or cheap. So when the stock price of whatever stock you're buying is high relative to whatever that company can earn in the future, it's expensive. So when you see that line go up, generally we would call that market expensive. When that line goes down, you're not paying a lot for whatever we think that the company can earn in the future. Over the last 25 years, the average price to forward earnings has been 16.5 times. You can see that there are big swings up and below that. Before the recent market downturn, we had among the highest valuations that we've seen in 25 years, ones that rivaled the COVID period and the pre-tech bubble bursting period. So again, this was driving our assessment of risk. I mentioned earlier we were focused on the Mag 7. Mag 7 were even more expensive than what this market looks like. And I will warn you, valuations are a terrible timing measure. Just because the market's expensive doesn't mean that it's going to turn down. But what it does mean is that the market is more vulnerable to negative news. And that's where we have the confluence of high valuations and policy uncertainty, right? The market is expensive, we had bad news, and so it corrected fairly quickly. The good news, so here's the silver lining of any market downturn, is that we're a lot less expensive than we were a couple of weeks ago. So we peaked at, I think, 21 times just a couple of weeks ago. Today, we're running below 20. So we're a lot closer to that average. So the flip side of the coin. So the question next is so here's how the markets have reacted. And I would argue that markets are still trying to figure out, number one, what the policy is and what the implications are. And we'll talk about some of the complexity of trying to forecast the implications of some of these new policies. But very important in this whole equation is how strong is the economy going into this shock, right? So what's the economic environment? We put together this dashboard, which we publish on a regular basis. And it's meant to be just like a helpful sort of summary of what it is that we're looking at. So these are the 5 main areas of the economy that we track on a regular basis. There are many, many indicators that you can look at for any one of these sections. And we look at those quantitative indicators, and then we make a qualitative assessment. So where on this spectrum should this area of the economy be rated? And I'll just highlight for now, we'll dig into some of these areas a little bit more, but I'll highlight for now that as you look down the 5 indicators, we're right about the middle. So that's a pretty decent place to be, right? There's nobody over way into the red. There's nobody way into the green. So each one of those is at some version of neutral. There have been other times in our sort of economic history where we were very much way to one side versus the other. So again, just a way of sort of thinking about this, that we're starting from a pretty decent place. So one area that we've been very focused on, particularly in terms of tariffs, has been the strength of the consumer. And over the last year or so, one way that we measure looking at the consumer is consumer confidence. So that's different than what we're looking at here. Consumer confidence is when you ask a consumer, how do you feel about your current situation, future situation, job prospects, are you going to buy a car? There are a number of different surveys that go out and try to sort of assess how consumers are feeling about their economic situation. Many of those indicators were very negative in that people were suggesting that they did not feel confident at all. But when we look at what consumers were doing, so where were they spending money, the answer was yes. And that picture has improved. So this is looking at real retail sales. What that means is that we're trying to take out the impact of inflation. What we want to understand is how many goods, right? What's the value of the goods that consumers are going and spending money on? And what you see there is that for a period of time in early 2023, we actually had real retail sales going down. So people were still spending money, but because of inflation, the amount that they could buy ate away at what they were able to bring home. That consistently improved through 2023, and towards the end of the year started to go positive. So even though individuals were saying they didn't feel good, they were going to the store and they were spending money. So that tells us, okay, maybe people are over-indexing on certain things. If they're feeling good enough to go out and spend money, that's a pretty good barometer of their level of confidence. A big driver of how good people feel about their economic situation is, not surprisingly, how they feel about their job. And so this is another area that we follow very closely. How healthy is the labor market? And in fact, for much of 2023, the labor market was viewed as too healthy. In other words, there were too many jobs chasing too few workers. And if you look at unemployment rates, so this is the level of people who are looking for a job relative to the size of the overall labor force, that unemployment level was among the lowest that we had seen since the 1960s. Now, towards the tail end of 2023, there started to be fewer jobs available, more workers looking for work. So the labor market started to loosen up a little bit, but remains quite healthy compared to any historical measure. This particular look is at non-farm payrolls. So how many jobs that are not related to the farm are there out there being created on a monthly basis? You'll see a nice big tick up in March, which was higher than what was expected. Now, we have the Doge layoffs, which have started to be reflected in some of these macro numbers, but so far are not big enough to subsume some of the other job creation that we've seen. So again, as we think about how well positioned is the US economy to deal with a potential policy shock, the labor market is pretty healthy. It will likely continue to loosen up some further, but you're starting from a pretty strong spot. Another very important measure to sort of identify the resilience of the US economy is debt. And there are a lot of different ways to measure this, and so you really have to put them all together to get a good picture. But these are two measures. On the left is a representation of corporate balance sheets. So we're taking all the 500 companies in the S&P 500, we're taking debt relative to equity. And what we see here is that the level of debt compared to the size of these companies has come down quite substantially over the last couple of years. And you'll see during COVID that debt level, at least relative to equity, went up significantly. That's because equity came down, and many companies actually took on additional debt because interest rates were really low. And so what this tells us is that overall, companies are not carrying a lot of debt on their balance sheets today. On the right side, it's a similar measure, but for consumers instead. So if you take all consumers in the country together, look at their debt, and then take all of their net worth together, that's going to include house, car, land, 401k, all of those things get all rolled up together. And then you compare debt versus all of those assets. Here's where you see a really dramatic change relative to, let's say, the global financial crisis. In 2007, you had people taking on enormous amounts of mortgage debt that created a lot of leverage in the system. Then you had a downturn, and then there was a ton of debt that had to be worked off. The difference between today and then is really stark in that, in aggregate, at least, consumers have much lower levels of debt today than what we've seen heading into other downturns. That's a positive sign. Now, again, this doesn't mean it's representative of everybody. There are certainly some consumers out there that have much higher levels of debt and who will struggle if interest rates go up or they lose their jobs. But in aggregate, when we're thinking about the overall economy, this tells us that we're in a fairly resilient place. Okay, so with that, we think the economy started off in a pretty good place. There were some risks in the market that have started to be worked out. So let's take a look at tariffs and what are some of the implications here. So we looked at this chart earlier, again, just trying to give a little bit of history. And I've gotten a number of questions from you, so thank you to all of you who have sent in questions ahead of time, and I see a bunch coming in through the Q&A as well. And John, if you go to the next slide, I want to share some of this, because there's a lot of sort of questions about why are we even talking about this? And I like to think of free trade and tariffs as two sides of the same coin. And as we look at that previous chart, you have tariff rates going down significantly. That was to promote free trade. Why do we want free trade? We want it, and there are a number of different reasons for pursuing this. So I tried to be sort of as inclusive as possible. You want stronger economic growth, kind of in the US and around the world, expand market access. So I want to be able to buy things that we're not able to make or grow here in the US. Boost innovation and competition. The idea is if you have more people around the world who are trying to come up with new types of technology, let's say, we'll get to a better end result if we have more people working on an issue. Lower prices. So this has been a really common story as we've imported manufactured goods from elsewhere. We're able to do that at a much lower cost than we can for making them here. But one piece of this whole puzzle that I think often gets lost, and I think is important to mention, is that free trade was often pursued by policymakers in order to have closer political ties. That's with both our friends and our adversaries. And so there's always been this very political component to tariffs. And there was this view that if you have economies that are knitted more closely together, that's also good for our political future. Now, that doesn't mean that there aren't costs to free trade. And there have been more discussions about some of the costs of free trade. Tariffs are a pushback against that. And so why do you want tariffs? You want to be able to protect domestic industries. You want to be able to give room for, let's say, US factories to make things that are consumed by US consumers. There's also been talk about generating revenue. So there have been a lot of calculations about if we have this level of tariffs, then we'll be able to bring in this level of revenue that'll help right size the budget. There's also been a lot of discussion about trade deficit and how that has been driving the level of tariffs that are being determined by the administration. And then also encouraging strategic industries. So this is a little bit different than simply giving room for US factories, for instance, to get built. There might be certain types of industries that we consider very important for us that we want to make sure happen here. So think like steel is often one that countries will carefully protect to make sure that they have access to steel because it goes into so many products that are made. Another example might be certain types of military technology or planes that you want to make sure are built here for strategic reasons. And then also, with tariffs, just like with free trade, there is a very political component to this. And in fact, if you look back a couple of months ago, when Trump first came into office, the first sets of tariffs that were announced were for things like fentanyl trade, immigration. These are political goals, not economic goals. And it doesn't make them illegitimate. I just think it's important to recognize that this is not always just an economic calculation. There are other things that are part of it as well. The other thing I want to highlight is because we've had essentially 100 years that have focused on promoting global trade, trade has become very important to our industrial complex and into the things that we do. And I share this one image that came from an article that was produced by the Wall Street Journal, and I thought it was a really interesting look at it. What they did was look at a piston and identify where it goes as it makes its way through the manufacturing process. And it's a little hard to read, but up top, you'll see number of border crossings is 6. It goes back and forth across international borders 6 times before it actually gets put in a car. And that's a piston. Forget about everything that goes into a car, how many times it must cross borders in order for that to happen. So right now, with these higher tariffs, we're starting to pull apart some of this interconnectivity. And this is part of the reason, the complexity of this is part of the reason why the markets and companies are really struggling to understand what is the impact on my business and on the broader economy. I also want to provide some perspective because there's been a lot of talk about sort of like the unevenness of tariffs. And this is much more sort of complicated to compute than you might expect. So this is a table that was put together by Capital Group. They do some great research. And I will note this is as of March 10th, so this has been changing dramatically. But what you'll see here is the average US tariff on goods from each of those countries. So how much are we charging on tariffs that get produced by these countries? And what's the average tariff that that country charges just on US goods? So this is a hard number to kind of get to. And again, it changes. And then you'll see that tariff gap. What's the difference between those two numbers? So a couple of things I'll point out here. One is that Canada and Mexico are not on here. That's because they're governed by a separate trade agreement. And when you look at areas like, I'll pull out Vietnam and India. Those are the two names that have the highest level of tariffs relative to these other trading partners. Those countries are much earlier in their economic development than some of these other countries. So I mentioned earlier, a reason why you use tariffs is to protect your domestic industries. When you have a sort of like younger, faster growing, more developing country, you're going to be more apt to put up those barriers in order to give your local manufacturers time to build. Again, you can argue whether or not that's in America's best interest or not, but that's the justification for it. We've also included here the VAT rate. So this is a form of tax that a lot of other countries put on goods. There's been some argument about whether or not we should consider that as part of the tariff. I would argue personally that if you're going to include the VAT, you also need to include sales tax, which we have in the US, even though it's levied on a state-by-state basis. But those two are meant to function in a very similar way. But I highlight this just to show, even to identify relative tariffs, you have to make a lot of assumptions and judgment calls as you go along the way in order to determine like what counts, what doesn't count, what matters, what doesn't matter. But this gives at least some picture of what we're trying to wade through right now. One other thing that I want to highlight when it comes to tariffs is that we do have a little bit of experience in seeing how the economy reacts, because the first round of tariffs were introduced, as I said, during Trump's first administration in 2018. Those were very focused on China and very focused on particular goods. So it was a much smaller effort than what we're seeing today, but we can still gather some lessons from that. So on the left, what we see is comparing November 2016 with November 2024, how much trade happened with China, Europe, Mexico. And what we see is over that 8 years, the amount of trade with China goes down by a fairly significant amount. That decline in trade is all made up with higher trade in Europe and Mexico. So what that tells us is that consumers and businesses were able to quickly shift their buying from the higher cost, from now relatively higher cost place, to relatively lower cost places. So being able to do that helped sort of mitigate some of the impact of tariffs. On the right there, you'll see certain products and the impact on prices. So that dotted line is looking at PCE, so the Consumer Price Index, looking at I think it's like dryers and a couple of other types of products that were very affected by the tariffs. Sorry, the dotted line is overall inflation, and then that blue line shows those particular products. And what you see is once the tariffs get implemented, they start to go in opposite ways, where overall prices are declining, but prices for the tariff impacted goods rise. Now, I share this because it tells us that when products have a tariff on them, their prices are likely to rise. That said, one important thing to remember is that most people, unless you were specifically shopping for a dryer, most people didn't notice. It was narrowly enough applied that it didn't impact the overall level of prices. And it was the general trend in prices that most people felt during that period. So again, this is a little bit of a microcosm. Today's approach to tariffs is much broader, but it does give us some insight into what to expect going forward. In that, consumers and businesses are likely to change their buying habits depending on who's less impacted by tariffs. And where you can't get away, where you don't have a substitute product, prices are likely to go up going forward. All right. So importantly, we all think, okay, how is this going to impact our lives? How are tariffs going to impact our lives? And I am a huge coffee drinker, and so naturally I'm worried about my cup of coffee. We want to use that as another example of how tariffs are impacting our everyday items. And so with that, we have another quick quiz for you. How do you take your coffee? I buy a cup of coffee. I buy a cup of coffee 3 to 5 times a week. I make my own coffee 3 to 5 times a week. I don't drink coffee. And if you answer, I don't drink coffee, like, I don't know if we can be friends. We might have to work on that. Okay, so this is interesting. Not that many people buy a cup of coffee 3 to 5 times a week. I thought this number would certainly be higher. But only 5% of you are telling me that you buy coffee regularly. And a full 17%, this is going to break my heart a little bit, full 17% don't drink coffee at all. The rest of you, like me, I make my coffee 3 to 5 times a week. I go out maybe once or twice for a treat for a coffee. But this is, it's going to impact a good number of you, what happens with coffee. So let's take a look at just this example that we have. If you think about the original cost of coffee, and this is just meant to be illustrative, right? Don't take this for gospel, but we did try to put a little bit of rigor behind this. So when you look at the original cost of a cup of coffee, then you apply tariff on Colombia. Only 1% of all coffee consumed in the US is actually produced in the US. So this is something that almost entirely has to be imported from elsewhere. So that 10% tariff on Colombia adds about a penny to your overall cost. Then if you think about the espresso machine that you need to make that cup of coffee, that's probably going to come from China, subject to 125% tariff. But we've assumed that the cost of that gets amortized over the number of cups sold in a year, right? Because that's not something that you're going to have to replace regularly. So that adds another incremental amount to your cup cost of coffee. Now, interestingly, the disposable cup that you get when you walk up to that coffee shop comes from China, probably, maybe Canada, but probably comes from China today, subject to 125% tariff. That actually is a larger driver of the cost of that overall cup of coffee than the actual coffee. So what's your tariff coffee cost? $4.43 versus $4.29. Now here we've also assumed that all of that higher cost gets passed on to the end consumer. The coffee company might decide to sort of hold on to some of that and ease some of that. So again, a lot of assumptions go into this. But I share this because sometimes the tariff impact is less than you might expect, right? Only 10% on beans, and that actually is not a huge contributor to my cup of coffee. But the paper cup actually ends up being a big contributor to the higher cost. So, I'm sure that there will still be coffee available for the coffee addicts like myself. But we might start to see these tariffs pulling through in sort of unexpected ways. And also it just highlights how difficult it is to really forecast exactly what all these impacts are going to be. So next the question is, and we're just going to run through a couple more slides and then I'll get to questions. How do you invest during this period? Because it is a very uncertain environment. It is very trepidatious. I know emotions are high. So what do we do? And I'll highlight, going back to that first slide, I had some of the risks that we were thinking of heading into the market. Because of that, earlier this year, we reduced overall portfolio risk. How do we do that? Generally, an easy way to do that is start to lower equity exposures, so own fewer stocks and more bonds. We also look to increase our allocation to international stocks, value stocks, mid-cap stocks. So again, going back to the idea of the Mag 7, those were the names that had done really well. They were really big and they were really expensive. So even in areas where we retained exposure to stocks, we were looking for areas outside of that Mag 7 to get exposure. And sure enough, some of those areas like value are areas that have done better than the more growthy or Magnificent 7 oriented names. Within fixed income, there are also ways that you can increase or lower risk. So there too, we moved shorter duration. That means bonds that have shorter maturities, and also moved higher quality. So I mentioned earlier, high yield bonds are ones of companies that are seen as a little bit more risky. We moved less out of those and more into higher grade corporate investments and other treasury and munis. So, I'll highlight, we're not going to get this right. We're not going to get perfect every time. Nobody can tell you exactly when these different asset classes are going to turn. But what we can do is dial up and down risk depending on the opportunities that we see and the risks that we see in the market. So then going forward, how do you think about portfolios during that time? And I like to think in times of stress, you want to have a back to basics approach. We talk a lot about diversification. And for a while, diversification was sort of a drag on your portfolio. As the Magnificent Seven names outperformed everything else, we would get a lot of questions like, why do I own these other stocks? Like they're just holding me back. Well, it's times like this when you're in periods of stress, when you're really glad that you own these other types of stocks, you're glad that you own bonds. And so we think a lot about how do these different pieces of the portfolio mix together to make a whole that's more resilient, that offers a smoother return stream over time. Again, it doesn't mean you can avoid volatility altogether. As an investor, you have to accept a level of volatility. But these are things that we think about ad nauseum to make sure that we're building these resilient portfolios. But I will say, we do this, it's more important to do this when the times are good. Right? We think about what could go wrong all the time when things are good. When things are bad, then we start thinking about what could go right. And so we challenge ourselves intellectually to constantly be building these two paths to make sure that we're ready for what comes. So what does come? Let's provide a little bit of perspective. As I mentioned earlier, volatility is something that an investor has to experience. And you're going to hear other people tell you this. I'm not the only one who's come up with this. But here's an illustration of why. When we look back to 1980, those bars are going to show you the annual return for that year. And you can see the last 2 years, we had really, really good returns. And then that dot tells you how much during the course of that calendar year did the market turn down. And what you'll see is even in the best years, there were periods of time when the market is down. And, as I was putting these numbers together, you can see the little note there. As of yesterday's close, S&P 500 was down 7% year to date. And then the maximum drawdown, so the most that the market had dropped during the period of the year was 19%. So that's a decent level of drawdown, but actually 7% year to date doesn't sound like that much of a decline, given how well the markets have done the last couple of years. And so this is not to say that we're done, but this is to remind you that we can have really good returns over time, even with that volatility in the short term. I also want to take you back to a couple of other instances in the market. So I've been in this business 25 years. I can recall these times at the drop of a hat, and I can still imagine myself being in each one of those. But I want to remind you of what these feel like as you're going through it. Because I've gotten a lot of questions like, this time is different, and there are all sorts of reasons why that is the case. You are right. This time is different. This is the first time in over 100 years that we have had such a huge impact of tariffs. But that doesn't mean that we haven't been through hard times before. And that doesn't mean that we won't figure our way out. So I'm going to guess that everybody on this call can remember what it felt like going through the COVID pandemic. So this is looking at the S&P 500 starting at the beginning of that year. You might want to forget this. I know there are times when I want to as well. But beginning in February of that year is when the market started to understand that COVID was coming to the US and it was going around the world and it was going to take lives and it was going to be a big impact. So you can see there, I just tried to share some of the headlines that came out during that time. These were really horrible things that we had to go through, really challenging. You'll see that chart on the lower right there. Those were the number of deaths that we were tracking in different countries around the world, depending on when COVID showed up on their shores. And John, if you'll click to the next one, I dug this out as I was thinking about preparing this. And this is a picture of myself. I looked, it was March 18th, 2020. My husband took it of me as I was sitting at my Bloomberg terminal in my makeshift office. My kids, I have 3 kids, and they had just been, school had just been canceled. And so my youngest daughter was sitting on the floor playing cards by herself. You can see my very healthy lunch of shredded cheese. That chart on the top middle is actually tracking the number of COVID cases and deaths worldwide, and you can see it just hooking up significantly. And it's hard to tell there, but I looked, the market was down 7% that day. And that was just one of the many wild swings that we had in the market. And I share this because this was the beginning of COVID. This was the beginning of being at home. This was beginning of understanding the complexity of the disease, no treatments in sight, and literally people were dying. And guess what? The market bottomed 1 week later. So we can have bad news and the market can digest it. And as long as we know what the way forward is, the market can start to turn up. And again, I don't know when the market is going to bottom, but the market does bottom when the news sounds terrible. And in fact, during this time period, that next week, we started rebalancing client portfolios, buying stocks, knowing that that was going to create a lot of anxiety with people. And it wasn't because we were smarter than everybody else. It wasn't because we had information anybody else didn't have. It was because we had a playbook. We had a playbook for what to do in these times of stress, and we were disciplined enough to follow it, as scary as that might be. But you know, sometimes this starts to feel that way. And I'm going to share two other quick examples. For those of you who are old enough to remember the 2009 global financial crisis, this one took much longer to play out. The COVID pandemic, at least from a market perspective, took like 4 weeks to really play out. The global financial crisis felt quite extended during that time period. Bear Stearns went under, Lehman went under, AIG went under. So we had one company after another starting to fall. And I'll just share, at the time I was working at AIG, which was under the gun, and I just had my first son. So, you know, if there were ever a time in my personal life that was very stressful, it was it. And on top of it, I was working in the middle of this maelstrom, and I was a stock analyst covering financial companies. In March of 2009, Citigroup fell to $1. Citigroup and Bank of America were at risk of being nationalized by the US government. People were taking cash out of their bank accounts because they weren't sure if the financial system was going to hold, and it almost didn't. But guess what? That's when the market bottomed. That's when people started to get a little bit more confidence in the government's ability to manage it, and that's when stocks started to rally. One more scenario that I want to share with you, which is 1987. If you follow my work, you'll know that I shared a story of this about my grandfather, who was an accountant, a very smart man, very numerate, had some small stock investments. But in 1987, after watching the fall, markets fell 22% in a single day. He sold every single last share that he had and never went back into the stock market again. He lived another 30 years without owning a single stock, and he missed out on one of the best bull runs that the market has ever had. And so I just share that again, like look at the headlines from that day. There's my grandpa. Look at the headlines from that day. I mean, absolute panic on the floor of the stock exchange. But these are times when we need to have confidence in the process. We need to be disciplined and look at the long term. So with that, I'm going to leave you with one last chart, which is one of my favorites. Oh, no, two more. I'm sorry. Again, just an example of what happens after that market bottom. This is looking at some of the 10 worst days since 1950 and what happens a year later. And what you see there, everyone except for one, you see significant gains 1 year later. And sometimes that first big drop down is not the first one, right? So look at 2008. You had a bad 10 days, then you get to October 2008, another bad 10 days, October, another bad 10, right? So sometimes you don't necessarily reach the final bottom, but even if you bought after that first 10 days down, you still had good returns coming out of it. So these downsides bring opportunity, but they are scary, right? And it doesn't mean that you're going to time it perfectly. So I promise, last slide, but it's one of my favorites. Stocks for the long run, put together by Professor Jeremy Siegel, who's really a giant in this business. This is looking at different asset classes going back over 100 years. He took out inflation so that we can compare different periods. And what you see there is that stocks, and you can see his quote at the bottom, I love it, even though they're the most volatile asset class in the short run, they're actually the most stable in the long run. And you can see how stocks kind of move around up and down around that red line. But remarkably, over time, fairly consistent, very consistently, stocks have returned about 6.6% on a real basis. So after taking out inflation, every year. So if you want to grow your wealth, stocks are a great way to be able to do it. And bonds, you'll see there, second best asset class of all of those, a great way to stabilize your returns, have a little bit more balance in your portfolio, but stocks are going to be what grow your wealth over time. All right, thank you so much. I'm going to go. I see a lot of you have been putting in questions. I'm going to introduce my colleague here, Derek Shug, who is head of portfolio management here. He and his team work very hard thinking about how to put all the different pieces of the puzzle together to create a better portfolio. So let me just kind of spin through and see if we can kind of find some themes. So Derek, maybe I'll toss this to you because we've thought about this a lot. There's a comment on the dollar and treasuries, and how do we think about the treasury market and maybe opportunities there as there's all this volatility with tariffs in the market?
Yeah, so that's a great question. I think given how this could play out, there's a lot of different views on what the long-term impact is on the dollar. So I don't think that we have confidence as to which direction it's going to go. What we've seen, though, over the short term is a decline in the dollar. And what that has meant for our stock portfolios is the international diversification, especially towards developed markets, has added less correlation and also better returns. And I think as long as that uncertainty is there and you combine that with the amount of debt that we have, that's probably not going to be solved anytime in the near term. Within bonds, we've actually tilted towards high quality corporates. So I think it would be hard pressed to actually make an argument that a corporation that's a AAA corporation is guaranteed to be a better credit than the US government. But I think the current administration's policies and rhetoric around treasuries and the debt makes investment grade high quality bonds a little bit more of a safer investment. We're actually seeing a ton of volatility day to day in treasury yields. We're seeing corporate spreads widen, but those higher yields and the shorter durations have been protective of portfolios. But I think it's always, currencies are really tricky, and I don't think we like to make big bets on currency directions. We will make bets at the margin, though, on things like increasing international relative to US.
Thanks, Derek. And I know we have just a couple minutes left, so I'm gonna run through a couple of other ones real quick. The question here is about the news on Trump pulling back all tariffs except China. So this is interesting. If you think back to the beginning of the day yesterday, there were very high tariffs across the board. By the end of the day, tariffs on everybody, essentially everybody but China, were off, but then Chinese tariffs were raised. If you calculate all the weighted tariffs at the beginning of the day and all the weighted tariffs at the end of the day, they're actually the same. So I know the market rallied, but if you sort of think about that effective tariff rate beginning and end of day, nothing really changed. What changed was where they were coming from. Now, you could argue that if all the tariffs get focused on China, maybe we have an opportunity to kind of move manufacturing to other trading partners, and companies have a little bit more flexibility to react to it, as opposed to high tariffs on everybody. But again, from a very macro basis, it doesn't really change all that much. Another question is, how does that economic dashboard look in April of 2025? It actually doesn't really look different. We sort of convened the team yesterday to stare at those numbers and see if we felt like anything was going to change. Now, the important thing is that there will certainly be economic indicators that change going forward, depending on how companies react to some of these tariffs. And there's another question here in terms of like, how do you sort of invest with just this like general level of uncertainty? And what I would say is the level of tariffs that we have is actually less important than knowing what they are going forward. It's often painful to sort of digest information at the outset, but companies aren't going to hire workers. They're not going to build new factories until they know what policies are going to be going forward. So the sooner that we can get to a level of certainty, the better off. And we have a couple questions here, and I think this is a really important one. I want to make sure we answer. What are the chances of recession? I think, again, a lot of uncertainty here, but I think the longer we go on in this uncertainty period, the higher the chance we have of a recession. But as an investor, I'm less worried about that because with the market down as much as it is, the market is pricing in a mild recession. So typically 20% down is consistent with a mild recession. So the market's already there. So if we have a mild recession, I don't think that there's much for the market to sort of digest. If it's an extreme recession, then there could be some more downside. Or if tariffs are off the table, then no recession and kind of markets take off. So I know that came up early on in the polling that people were very worried about a recession. As an investor, I'm a lot less worried because the market's there already. Derek, I'm gonna spin through the questions one more time, but anything you want to add before we close out?
Yeah, I think one of the other ones that stood out to me was the question about, when you reference COVID, that was obviously an external cause. And in this case, it's essentially a self-induced sort of uncertainty that's being put in here. And I think, in COVID, what was interesting on the same side of things is what saved us from COVID was government intervention, stimulus, and things like that. And the same kinds of things, if these tariffs do sort of play out into Trump's levels, the current administration's levels, right? We know it's a huge tax on investors. It might lead to recession, but yesterday is a great example. He came out and said, well, I'm going to delay it. So I do think there's this concept of whether it's a Fed put, as it has been historically in the '08 crisis, or a congressional put in the COVID crisis. Yesterday was just a tweet put and one-term market commentary put. And if you do think of the administration's long-term legacy, I do think they want to leave a positive long-term legacy. So there will be positive things that happen, while like days like today, the news has turned a little bit more negative again because 90 days is just a pause. And during this volatility is when you want to have your strategy already set coming into it. You've been risk profiled by your advisor. They're watching the markets and finding opportunities for you and sticking to that plan and knowing that this is likely to be resolved in 3 to 9 months, and then things will probably look fine again, is usually the best path of action.
And so along those lines, I'll reiterate, some of the message that Derek had, which is we're big believers in being long-term investors and sticking with a plan. We develop those plans in good times so that we're ready to go in bad times. And so when we say stick with your plan, we're not saying that because it's easy. It's actually really hard, right? That's why I went through all of those previous examples and showed sort of like the anxiety, the emotion that was happening during those periods. Those were really important periods, very difficult to get through. It was not easy to stick with our plan in March of 2020 and actually buy stocks, but it was the right thing. And we had developed that in sort of times when our thinking was fresh and clear. So talk with your financial advisor, revisit your financial plan. It was built for a reason. It was built to get you through these tough times. You can also look at opportunities to tax loss harvest. You can generate some losses now that can offset gains later. And then if you're able to, look for opportunities to invest new money. I got a bunch of questions about this recording and the deck. We will have those available as soon as we can. We need to have them reviewed and then we'll send them out. And thank you to all you coffee drinkers out there. I know a lot of you wrote in the chat. You guys are welcome anytime. And thank you. And I know it's rough seas out there. Please reach out if we can do anything else to support. And as always, invest wisely, live richly. Take care.